I think you're muted, Professor, just so you know.
Oh, sorry for that, guys. How are you doing? Now, do you hear me?
Yeah, I hear you now.
Excellent, excellent. So last class, guys, what we were saying is that inflation basically allows me to have two types of interest rates. One that is the current or nominal interest rate. Okay, let's call IC. And this must be always equal to keeping my purchasing power, inflation, and also give me a real interest rate. Okay, so this formula is the one that we were discussing last week. Okay. Now, a couple of things, guys, that before moving forward with more of these cases. Do you remember? There is something that I need to talk about you. Yes. Okay. So, have you heard about the balance of trade? And this is very important because the people always talk about this one here. The balance of trade, guide, is simply the difference between X minus M. Exports minus imports. Okay, and then if this is larger than zero and smaller than zero, so we say that we are in a deficit. So we are buying more than what we are selling to the foreign countries, or we are in a superaverage. Okay, now what is interesting, guys, is the following. Why that the people pay a lot of attention to this variable here? You remember, guys, that central banks always care about the FX, the exchange rates. Do you agree? So what they want to do is they want to minimize volatility. Remember that the trend is very tricky, so you cannot do basically anything against the trend. But what you want to do is you want to minimize volatility. Guys, by the way, before I forget, have you received? Fordham told me that they have sent you emails already they have created a channel in YouTube for you to take a look to the previous classes. Have you received an email? No? Okay, I will follow up tomorrow because they told me already on Monday that they have done that. I will follow up and then let you know, okay? Okay, so let's go back. Central banks, remember, they always care about FX, even though they say that they don't have this as part of their policy, but they need to keep it because what they want is to keep this volatility. Now, remember what type of transactions or actions they do in order to minimize volatility? They do two things, basically. Something that we call open market operations. Basically, buy and sell dollars in open markets. Or basically they use bonds, sterilization. And we said, and we show you, that, and I discussed this a lot, that basically in real life sterilization normally doesn't work. Guys. Now, what is the problem with open market operations? They require buy or sell dollars, agree? Let's say foreign currency. So this implies that you need to have foreign currency. Correct, guys? So that's why central banks sorry. So that's why, guys, they have foreign currency reserves. Okay, so they have euros. If you're in South Africa or you're in Peru, you have dollars, etc. It is international foreign currency reserves. And the international foreign currency reserves, guys, are part of international reserves. Okay, so the international reserves basically contains the foreign currency reserves. Now, guys, if we pay a little attention here, if you want to do, as a central bank, open market operations, so this implies that you need to have a positive balance in foreign currency reserves, correct? So this implies that you need to buy euros, for example. So where do you buy the euros from? Well, governments indeed go outside and they buy euros, but also they buy euros internally, right? And where these euros come from? Internally. So remember, guys, exporters bring or remove foreign currency. They bring foreign currency, do you agree? Agree with me, guys? Because they sell their products in Europe, for example. Europeans pay them in euros and they bring the euros into America. Into America, they exchange it. But, well, the dollars is very strong, so perhaps it doesn't work. They can pay you in dollars also in Europe. But if you go to a developing country, for example, Peru, for example, when you are an exporter, you export your products and they pay you in dollars. And then you bring your dollars into your country. Right? And what about the importers? Let's call it remove. So from the local currency, from the local markets, they remove foreign currency. Got it? So now, money in, normally when euros get into the economy, the private sector basically buys and sells them, do you agree? But also there is some part of these euros that central banks buy. Make sense? Now, remember, there is going to be an excess of euros if and only if X is larger than M, then we have more euros in the economy. Agree with me, guys? So having more euros in the economy implies that the private sector can buy and sell them. So there is more stability. There is no shortages of supply. And central banks can also buy them. So basically, guys, having this one here, one of the reasons of having X greater than M, of course, besides the competitive side of the equation, it is also because you are bringing foreign currency to your country that provide you the tools to keep stability on the exchange rates. Okay, because you have the euros to trade with them.
Professor,
Yes.
when you say more euros in the economy, do you mean like a non-euro economy? Or
Yes. So euro is my foreign currency. I'm assuming this is my foreign currency. You know, USA is it's kind of tricky because normally international trade is also done in dollars. Okay, so for American corporations, it's very tricky to bring euros into America. It's basically you bring your dollars because you trade with dollars. But if you put yourself in any other part in the world, except USA and perhaps Europe, the trade happens in dollars, for example. So imagine if you're in Peru, you sell your products to USA or to Europe, they pay you in dollars. So you bring these dollars into your economy, you see, into Peruvian economy. And remember, you don't pay in dollars in your local country. So what you need to do is you need to exchange the dollars. Where do you exchange the dollars? Basically, you sell it in the market. There's people buying and selling dollars. So this is the private sector. But also one big player in these economies are central banks. They're always buying and selling. Why? Because they want to keep basically this one here. They always try to minimize the volatility. Remember that? Okay. So remember, the central banks cannot do anything against a trend, but they try to minimize at the maximum the volatility. Okay. And why they want to do that, guys? Because stability is something that international trade requires. You cannot be just trying to buy or sell products when the exchange rate is going to be high or low, later high again, low again. So there is a lot of uncertainty on that side of the equation. And as soon as these economies don't have a very strong hedging mechanism, they don't have futures or they don't have option markets as developed in the USA. So the central bank is basically the one that regulates this type of issues. Makes sense? In USA, guys, you don't have issues or any other developed economy because you can hedge your position. You can do a future. This is the second part of the class. We can do options. We can do futures. Got it? And so what I do is I'm here. I lock the price of the currency for in 3 months, and that's it. I disappear my risk. Got it? So for me, it really doesn't matter if there is a lot of volatility. Of course, it matters because the price of the options or the futures depends on volatility. But indeed, once you lock your position, you're done. It doesn't matter if the price goes up, the price goes down. You know where the price is for you. Got it? But if you go to Latin American countries, for example, or African countries, or several Asian countries, they don't have these mechanisms. Right? So the price now, I don't know what is going to be the price in 3 months. Can be up, can be down. I have no idea. Right? And if the volatility is like that, it's very tricky for me as a corporation to plan ahead, to look ahead. I don't know what is going to be the price because if there is a huge depreciation, I can price it differently than when there's a huge appreciation. So that's the role of central banks. Central banks are always trying to manipulate the economy or the exchange rate in such a way that the volatility is low. There is volatility, but the volatility is low, right? And this helps basically traders, helps the local economy in general. Make sense? Okay, so now this is one of the things that I needed to remember you. So let's continue now with what happens when we introduce foreign exchanges. Okay, so let me do again a very simple example. Imagine, guys, this is dollars per euro. Okay, so this is 115, 125. I'm exaggerating. Okay, 127 and 133. Okay, so this is my exchange rate. What I will call my ID, interest depreciation, my depreciation rate. So ID is going to be called my depreciation rate. It's called depreciation rate, guys, but also can be appreciation rate, but the common name is depreciation rate. So how do I compute the depreciation rate between this period and this period? What's my calculator? So the depreciation rate is going to be 1.25, sorry, 1.25 divided 115 minus 1. So here, for example, this one here is going to be 0. Sorry. Well, I'm exaggerating. It's too much. So this one here is 8.69%. This one here is 1.6%. And this one here is 4.72%. Okay, so I can call this E0, I can call this E1, E2, E3. So E is the exchange rate. Make sense? So note ID is a compounding rate. So the depreciation rate is treated exactly the same as the other interest rate that we have been working with you guys during the last couple of classes. Okay, so based on this, can you please tell me what is the depreciation rate for the 3 months? Can you tell me, so this is A, can you tell me what is the monthly average depreciation rate? And let's do a C. What is the annualized? Depreciation rate. Okay, 2 minutes to do that. You guys ready? So how do you compute the depreciation rate for the 3 months? If it's like a compounding rate, guys, you simply do what we have done. This is going to be 1.0869 times 1.016 times 1.0472 minus 1, correct, guys? Guys, you agree? it is exactly the same as inflation. It's exactly the same as the examples we have been doing before, guys, a compounding interest rate. So what do we get here? Someone?
15.64%.
15.64?
Yeah.
64%. Perfect. Someone to confirm? Guys, I need someone to confirm so you can replicate these values later.
Yeah, same answer.
Excellent. Thank you, Alexa. Okay, so now we have this one here. What is the monthly average? It's not, guys, don't do the mistake of dividing this by 3, huh? Because this is a compounding rate, so it's a geometric equation. So the way you do that is basically, if I translate the question is, tell me what is the depreciation rate for 1 month. Remember we did time transformations before? So this should be equal to, if I use the 3 months, it's going to be 1.1564 to the power of something minus 1. So what do I write in the power? What goes up?
1,
1 and down?
3.
3. So this is the power, okay? It's not multiplied by 1/3. It's power. Can you give me this value? It's 1.1564 to the power 1/3 minus 1.
$4.96%.
4.96%. Someone confirm?
Confirm.
Perfect. So what is the average depreciation rate for each of the months? 4.96%. Obviously, it's different than the 15.64 divided by 3. Finally, guys, what is the annualized interest rate, the depreciation rate? Well, if I translate this into our wording, this is what I'm asking, correct? So if you want to use the quarterly data, you use it, or if you want to use the monthly data, you use it. Okay, let's use the monthly one, or the quarterly one. So this is going to be 1.1564 to the power of something minus 1. So what goes up if this is quarter? What goes up?
One.
No, because I need 12 months. So remember, this is always like that. This goes up, this goes down. So up goes what? 12. And this rate corresponds to what? 3 months. Exactly. Guys, you need to study, please, okay? Otherwise, you are going to get confused and confused and confused more and more and more. You need to study. So what do we get here?
%7.8%.
No, should be more because it's 15.
My bad. Oh, hold on. 78.8%. Sorry.
Yep. 78.8%. Someone to confirm?
Yep.
Confirmed.
Confirm. Perfect. This is the way you work with exchange rates, guys, up and down, okay? We have questions, guys? It's clear?
Sorry, Prof. So I just want to make sure the timeline that you gave us is in months, right?
Yes, 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 yes. Make sense? Now, guys, I need you to pay a lot of attention here. Let me do something for you, okay? So take a look at the following. I will do the following cash flow. I get a loan in euros. So my principal in euros. I'm in USA, okay? But I got a loan in euros. Then after, some period of, after 1 year, one period, I will need to pay the principal times my interest in euros. Make sense? That's it. It's very simple. Why don't you follow me for a minute, guys, and then I will give you time to copy. Okay, just follow the idea. Now, assume that at time 0, I have an exchange rate equals 0. Oh, sorry, before going here, tell me, how do I get E1 in terms of E0? How do I get this 125 if I know that this is 1.15 and this is 8.69? How do I get E1? Do you understand what I'm asking? If I give you E0 and I give you the depreciation rate, can you compute E1?
Yeah.
How do you do that?
Multiply the depreciation rate with the current exchange rate, and then
No,
use
1 plus
that.
the depreciation rate, correct? Exactly, times E0.
Yeah, and then
Okay.
you just use that to either add or subtract depending on
That's it. So it's
what the sign
E0,
is.
completely right. 1 plus ED. That's the way it should work. So basically, if you do 1.15 times 1.0869, you should obtain 125. Make sense, guys? Now, if I have a time 0, E0, I will have a time 1, E1, obviously. But I know that E1, guys, equals E0 times 1 plus ID. Agreed? By this one. Okay, so now what I will do is I will transform everything into dollars. So this one here, let me say, is dollars per euros. So if I multiply this one here times E0, I obtain the principal in dollars. Do you agree with me, guys? Okay, so what I will do is I will rewrite this one here. And I will do, this is my principal in euros. I multiply this times E1. So I obtain now, this part here is my principal in euros at time 1. Sorry, principal in dollars at time 1. So if I do this, this is my principal in dollars at time 1. Agree with me? Now, I know that E1 equals E0, 1 plus ID. So what I will do is I will replace a little more. So this is going to be P in euros, times E0, 1 plus ID. This is my E1. That multiplies 1 plus I dollars. So all this one here, guys, is in dollars, correct? Agree with me, guys, or not? So if this is in dollars, this is an amount in dollars, and this is another amount in dollars. I want to compute what is my interest in dollars. Well, my interest in dollars, guys, follow me, please. It's going to be all this part here, P euros or times E0, 1 plus ID, 1 plus I euros, minus the original P euros times E0 divided by P euros times E0. Do you agree with me, guys? That the simple interest rate computation. Future value minus present value divided by present value. Now, if I simplify things here, I simplify this part here, goes all the P euros times E0 disappear. So finally, I obtain this formula. It's going to be equal to 1 plus ID that multiplies 1 plus I euros minus 1. So this equation here is very important. Okay, so here, attention, guys. Depreciation rate plays a huge role on your decision making. Let's do one example. Do you have questions about the way we arrived to this formula? Okay, let's do one question, one example. Imagine, guys, the following. Let's assume that you have a project in USA. Okay, let's assume that this project will produce 10% per year. Okay, let's assume that this is a kind of a certain stuff, 10% per year. Okay, let's assume, guys, that you get a loan in euros. The interest rate in euros is going to be equal to 5% per year. Let's assume that the depreciation rate equals 6% per year. Okay? The question is the following. Do you accept a loan and invest in the project?
Professor, this is the only, there's no other opportunity cost.
No. That's all. Okay, 5 minutes to do this stuff, guys. Guys, if you have questions, please ask me, okay? 2 more minutes, guys, and then we solve it. One more minute, then we solve it, guys. Ready, guys? Which question are you with? One more minute and then we solve it, okay? Please. Guys, let's solve it. So we have time to do more. Okay, so let's do Q1. Well, in Q1, we have all the pieces of information, right? I have a project in USA that produces 10% per year in USA. I can get a loan in Europe for 5%. And then I know that depreciation rate in USA is going to be 6% per year. Okay, so what is indeed this 5% is equivalent to what in USA dollars if I consider an ID of 6%. So basically, guys, I know this one here is going to be 1 plus 0.06, 1 plus 0.05, minus 1, correct? So what is this number here?
11.3%.
11.3%. Someone to confirm?
Confirmed.
Perfect. 11.3%. So what is the meaning of this one here? Basically, guys, if you face a depreciation rate of 6%, and then you have a loan in euros at 5%, the equivalent in dollars is 11%. Now, if you have a project that produces 10%, what do you think? The 10% is smaller than 11.5%. This is my cost. Do you agree? This is my profitability. So if my profitability is smaller than my cost, it's good or bad?
Bad.
This is bad. So basically, no project. Agree? So that's the idea, guys. If of course, a lot of uncertainty. Normally, this number here, this 5%, yeah, it is known in advance. You go to the bank, well, unless you have a LIBOR plus something, but it's more well known than this number here. This number here is completely uncertain. Can be 6, can be 3, can be 2, can be 10. Well, not wide variations depending on the economy, but it can change. Questions about Q1? Break even. Always break even, guys. Or break even analysis is something that you must do every single time you do something. So break even in this case implies that my cost equals my profit. Right? So this means that basically, what is the number? What is the depreciation that allows me to be break even? Correct? Do you agree with this equation? Guys, you agree? Perfect. So if you solve this equation, guys, you have only one unknown. It's going to be ID here. Of course, it's going to be equal to 1.1 divided by 1.5 minus 1, correct?
Yep.
Okay, so this equals what?
4.76%.
4.76%. So why the break even is crucial, guys? Because it tells you if ID is smaller than break even, what do? Do the project or not?
Do the project.
Do the project. What happens if ID is larger than break even? Obviously, don't do the project. Correct, guys? And this is going to help us to solve Q3, because what we can do is the following. ID, I will copy all the numbers. If ID equals 2%, if ID equals 4%, if ID equals 8%, so what I do? We do the project because 2 is smaller than 4.76. 4 is smaller than 4.76. I do the project. 8 is larger than 4.76. I don't do the project. Got it? So this part here, guys, is part of something that is called sensitivity analysis. Okay, we're going to do that later. Questions, guys, up to now? No questions, is clear? Okay, so let's go to another example. Let's assume, guys, that you have the following case. You have a loan, 5 million euros. And then basically you're going to have 2 periods to repay. 2 years. Let's assume that my interest rate in euros is 5%. Let's assume that my interest rate, bank interest rate in dollars equals 8%. Let's assume that here my E0 equals 1.05, my E1 equals 1.08, and my E2 expected is going to be equal to 1.12. So E0 means, or E in general means dollars per euros. Okay, copy and then pay attention to what I'm going to tell you. Okay, so can you pay attention for a minute, guys? So now if you assume that 5 million euros loan that you're going to repay in 2 years, okay, that's it. There's no issue with that. However, guys, you are in USA, okay? Sorry. You are in USA. Now, imagine, guys, that you are at the end of year 1. Okay, so you are here. You know this exchange rate is $1.08 per euro. At the beginning, it was $1.05 per euro. And then here, what you make you make an expectation, you make some calculations, and then you expect that the exchange rate in 1 year, so from 1 year to year 2, is going to be 1.12. Got it? Now, you also have access to an American bank. An American bank can lend you money at 8% per year. The question is the following. If you are here, do you exchange? So do you swap your debt in euros by debt in dollars, given these characteristics? So what you can do is imagine, if you decide to change, what you do is you go to a bank, get dollars, exchange your dollars into euros, and pay the debt to the Europeans. Got it? If you decide to keep in euros, okay, you don't do anything. Okay, guys, tell me, do you swap or you don't swap? My question is, do you swap your debt in euros by debt in dollars? This is just try to get to a point. Let's say 5 minutes to do this stuff. 3 more minutes, guys. Okay, 2 more minutes, guys, and then we solve it, please. Daniel, what do you think? Do we do the swap or not?
Sorry.
We do the swap or not?
I think no.
Okay. Okay, I have one no. 2 more minutes, guys, to everyone, so everyone can provide me with your opinions.
We just use the same formula, right?
I don't know. Yeah, let's take a look.
I just use like
Yeah, that's good.
the break even point for me is 2.85%.
2.85, yeah.
Yeah, so
So let's take a look.
it's above that. The depreciation is a little higher, so
Right. Ready? Okay, guys. So I have one that says no, no swap. Another one, another answer. No swap or yes swap. Paul?
Swap.
Swap. Okay, Alexa?
I guess swap.
Swap. Kagiso? What do you think?
I think swap.
Okay, and Kutso, what do you think?
Swap.
Swap. Okay, so majority rule, Daniel. They say swap. Okay,
Oh.
let's take a look to what happens. Okay, so let's do this by logic, okay? So first of all, I need to know how much money I owe to the bank, to the European bank at period 1. You agree? So how much money I owe here is going to be simply 5 million times 5. So at this point, I have 5 millions times 1.05. Do you agree? So this is my debt in euros. So let me see. Times 1.05. So I owe here to a bank 5,250,000. Everyone agrees with that. Now, if I keep the debt in euros, my debt one period ahead is simply multiplied again by 105. So my debt in euros, if I just wait, is going to be 5,512,500 euros. Okay, so this is the euro side of the equation. Make sense to you? Now, imagine that I'm here and I decide to take a loan in dollars. So how much dollars I need to look for? Enough dollars to buy the 5,250,000 euros, correct? So what I need is, I need 5,250,000, this is euros, times 1.08. So I need in dollars, I need 5,670,000. Everyone agrees with me? Okay. Then what I do with this money, if I decide to take the dollars, I simply take these dollars, exchange into euros. I obtain the 5,250, and I pay the debt in euros, and then I'm out of euros. Now, how much I need to pay in America? Well, I multiply this times 108. Correct, guys? This 108 comes from the interest rate. So this is 8%. Yeah, this number is the same, but it's not the same. Times 1.08. So my debt in dollars at the end of the second period is going to become 6,123,600. Agree with me? Okay, now it's easy. So I have a debt in dollars and I have a debt in euros. So I can transform this one in dollars into euros into dollars, correct? Guys, so what I will do is I will move this guy just here. So this is equivalent to 5,512,500 times 1.12. So this is equivalent, this is euros. And so my answer is going to be in dollars. 5,512,500 times 1.12. This is equal to 6,174,000. You agree? So now you compare these two guys. Obviously, as soon as this is a cost, which one do you prefer? Which one do you prefer, guys?
The smaller one. The one
Yeah, I prefer this one. Agree with me, guys? Everyone is clear with me? So basically, it is better to swap my currencies. Okay, now let's take a look to the break even. I didn't ask that, but you know, Daniel is right. Always we need to check, we need to take a look to the break even. Okay, so the break even, guys, the break even ID, the break even E2. So what I need to do, guys, for my break even is simply saying, okay, I have 5,512,500. If I multiply this times E2 star, I want to obtain break even implies that these two numbers are going to be the same. 613,123,600. Make sense? And then from here, your E2 is going to be equal to 6,123,600 divided by 5,512,500, 112. Sorry, this is equal to 11.09%. So what is the decision rule here? If E2 is smaller, expected E2 is smaller than 0.11.2, or if E2 expected is larger than 11.02 or 09%. So what happens? What happens in this scenario, guys? So you are the ones that have the loan. So this is a cost for you. You agree? So what happens if the exchange rate starts increasing? Remember, depreciation, guys, when you have a loan in a foreign currency, attacks you, kills you. Do you agree? Because you're going to need more local currency per euros. So basically, if this happens, what is best for you? Guys, this is bad for you, right? Yes, the exchange rate going up, so depreciating, is bad for you. So if it's bad for you to keep debt in euros, you basically swap. Agree with me or not? But if you have expectations that the exchange rate is going to go down, oh, sorry, I did something wrong here. Sorry, guys. Sorry. Error. This is not in percentage terms. This is indeed. Let me delete this one here. Okay, let me delete this part here. This is a number. This is currencies. So this is equal to 11.11. So if the exchange rate is larger than 11.11, you swap. Like here. Here in this case, it was 1.12. Larger than this, you swap. If this is smaller than that, keep euros. Yes or no? Okay. Questions? So we can do something more now. Okay, 2 minutes to copy, guys. Yep. So let's go to something more. Now let me do, and with this one here, you have the complete picture of international trade in terms of finance, guys. This equation is fantastic. You want to see. Now, remember, guys, that there is a missing piece of the equation. Okay? So normally countries also have inflation. Got it? So that's why we have current or nominal versus real terms. Got it? So let me rephrase my graph. Remember, I told you, okay, I have this. I told you, okay, I have euros. If I multiply this by E0, it's going to be as P euros times E0, 1 plus ID, 1 plus I euros. Okay, so this was the summary of what we did in the previous cash flow, guys. Now, how do I include inflation? Remember, guys, inflation allows you to deflate something. Guys, inflation doesn't happen at time 0. Inflation happens at time 1. Got it? So my dollars, my interest dollars, real, is now going to be equal to what? Well, I need to deflate the future value of my loan that is already expressed in dollars by the inflation rate. This is my deflated value in the future because the purchasing power of my money decreases in time. So that's why I do 1 plus pi. Okay, how do I compute the interest? The real is going to be this number minus the original one doesn't change over the original one. Okay, if I simplify these guys, my real is going to be equal to, so all these guys go out, is going to be is going to be 1 plus ID, 1 plus interest in euros, divided by 1 plus pi minus 1. Okay, so this is the first form of my equation. Make sense? So now let me do an example for you. Basically the same. I'm in USA. I have a project in USA. That has an internal rate of return, so profitability 10% per year. I know that ID equals 6%. I know that inflation equals 1% per year. Expected, no? So all of these guys are expected guys because we are now and we expect this in the future. Several things can happen in the future that ID can go up or down, but let's assume for now that this is there is no risk on this forecast. We're going to do this. We're going to complicate our lives later. Okay. Let's assume that I get a loan in Europe, in euros, and the interest rate in euros equals 5%. Now let me perhaps change this a little. So let's do 3%. Okay.
Sorry, Professor, what's IT again?
Oh,
The
depreciation
inflation?
rate, the depreciation.
No, the one below that IT, or is that
Oh,
that
I
pi?
am this one.
No. Below the depreciation rate, the 1% per year.
Oh, pi
Ah, that's pi. Okay,
inflation.
how's
Yes.
IT?
Yeah,
Yeah,
no.
okay.
Pi
That's the inflation.
inflation, right?
Okay.
Inflation rate. The question is, do you do the project? Okay, 2 minutes to do that. Ready? Do you do the project or not? Yeah, you do it. Well, in this case, guys, it's we simply replace the values in here, right? So I need a real dollars should be equal to 1.03 times 1 dollars euros equals 5% over 1.01 minus 1. So what do you get here?
7.08%.
7.08%. Okay, so now this number can be compared with this number.
It's smaller.
Yes, it's smaller. Yes, but do you agree with that?
Yeah.
Now, guys, there is an issue here. Okay, perhaps I didn't mention this one here. But in general, when you have a number, an IRI 10%, nothing else, okay, by default, oops, by default, this is current. Okay, by default. So then we have an issue because this number here is real and this one is current. We cannot do that. We need to do real, real, or current, current. Okay, so this implies that I need to transform my IRR that is current into a IRR that is real. Okay, so remember, guys, by default, when no one tells you it's real or not real, it is assumed that it's current. Now, how do I transform? Do you remember we have a formula? We know that the current interest rate equals 1 plus pi, 1 plus the real minus 1, correct? Okay, so I have this one here, I have this one here, so the only missing is this one here. So if I do some very brief, simple mathematics, this is going to be the real is going to be 1 plus IC divided by 1 plus pi. Do you agree? So this was the formula that we used when we dealt with inflation. And then from here, we simply replace the values. So my IRR real is going to be 1 plus IRR.
Minus 1 at the end of it.
Completely right. 1 plus IRR, current 1 plus pi minus 1. So we replace the values. 1.10 divided by 1.2 minus 1. So what is this value, please? What is the value?
7.84%.
7.84%. Now you can compare. So basically here cannot compare. Real versus current. But now you can compare. You can use this one. You can compare. Make sense? And so what is your decision?
You would take the loan.
Yeah, real that is equal to 7.84% is larger than my real that is equal to 7.08, then do. Because this is my cost, no?
Sorry, Professor.
Yes.
Is inflation rate 1 or 2%?
1. Oh, my number doesn't look like 1, but it's 1. This one?
Oh, okay.
Yeah.
Oh, I think you wrote 1.02.
Oh, you're completely right. It's 1, 1. You're completely right. So what is this number? Well, it's going to be better. So what do we get here? Sorry, guys, mistake there.
8.9%.
Yeah. .9%. This is 8.9%, larger than 0.9, so we do it. Make sense? Okay, 1 minute to copy. Then we do one last thing for the class. For those of you that are ready, guys, what is the, assuming the remaining data, what is the break-even ID? Okay, so continue assuming inflation equal 1, a 5% interest rate in euros, etc. So what is the break-even ID? Can I change pages? Yep.
Yeah.
Okay, so my question is, so question 2, what is the break-even ID? Someone? Daniel?
Oh, are we solving it now?
Yeah. So
Oh, okay.
what is the break-even ID? So if you can solve it,
all right. Okay, my bad.
no problem.
Professor,
Yes.
I just realized now. Shouldn't we also take into account inflation from the euro side as well?
For this one here? No,
No,
No, because remember, you are
if
in
we're doing the
USA.
project in the last one.
exactly. But remember, you are in USA, so that was a crucial aspect of the thing. So you are
Well,
here
it
in
could be
USA.
deflation from their perspective, right?
Exactly.
So-
So it is. You know,
Like-
you got it.
All right.
Yep. So basically, you need to use this formula only, right? So you have the real. So for being break even, you need to use a 8.9. Correct? That is real, so that's okay. So you want this to be 8.9. You have, this is 5, this is 1. So the only unknown is ID. So you should be able to do this very quickly. And I can do that so we can move faster. Yeah. So I know that $real equals 1 plus ID, 1 plus I euros, 1 plus pi minus 1, correct? If I want a break even, implies that $R equals to my IRR real. So this implies that this is going to be 0.089 is going to be equal to 1 plus ID. Well, from here, I can do something. I can do, this is 1 plus I dollars real multiplied plus 1 plus pi divided by 1 plus I euros. Correct? I'm doing, no, mistake. I'm tired. Oh, no, it was okay. It was okay, That's okay. So this one goes there. So this is going to be 1 plus IR dollars. This one multiplies up, 1 plus pi. This one here goes down. And as soon as I have 1 plus, the minus goes here. And this is going to be my ID. Agree? Guys, agree? So basically here, what I'm saying is my ID equilibrium break-even is going to be 1 plus 0.089. This is my IRR real times 1.01 divided by 1.05 minus 1. Agree? So what do we get here, guys?
$4.76%.
Someone to confirm?
Confirmed.
Confirm. Perfect. Okay, guys, so we stop here. I think we have done very good material today. Please study, okay? Because we're going to be working and playing with these concepts here and there. So you're going to get lost if you don't follow up what we have done up to now, guys. Right? So the last two classes, that previous class and this class, are crucial now. So because now we're getting into some mathematics, and we're going to be always applying the concept of depreciation, appreciation, how this affects investments, how the central banks can respond, etc. So always is going to be just modifying and talking more about these ideas. Okay, guys. Okay, so see you next week. So we continue. Please study and have a nice week, guys, and see you soon.
Thanks. Have a good one.
See you guys. Take care. Bye-bye.
Appreciate it.
Bye,
Thank
guys.
you, Professor.
Bye.